Hi everyone, good evening. Today we will cover a company called PNC Infratech Limited. The analysis of this company was requested by one of the viewers on the channel. Now, I personally don't like infra companies all that much because they are guzzlers of capital for any kind of project. They need huge amount of investments and the returns are middling at best. But yes, they form a very important part of the overall ecosystem. Without these companies, we won't have the kind of infrastructure, roads, ports, and the buildings which we see. So yes, they have an important part, but I personally am not very gung-ho about that business, that space as such. Keeping that aside, let's get into PNC Infratech Limited now. It was formed in 1999. It is a decently large company with 8,000 crore kind of market cap as of 1st October 2024. With the projects it undertakes includes roads, highways, bridges, flyovers, power transmission lines, airport runways, industrial area development, and other infrastructure activities, including water. They've recently started bidding for railways also. So overall, they are into the entire spectrum of infrastructure activities. In terms of geographical spread, they are present in about 16 states within the country. So they are a fairly large and pan national kind of a player. We will of course cover PNC Infratech in three different models. One, we'll quickly do a financial analysis of the company itself. Secondly, we will compare it to its peer group in terms of the financial numbers looking compared to its peers. And lastly, but not the least, after reading through the presentation, the conference call transcripts and so on and so forth, I have a few points which I have seen, which I will tell you. Those will more or less cover the analysis. So when it comes to the financials, as of 1st of October 2024, it's got revenues of 8,700 crores, a profitability after tax, profit after tax of 575 crores. It's got a debt of almost 8,000 crores on its books. That's quite a lot of debt for the kind of turnover it has. It also has a cash and bank balance of 1,300 crores with investments of about 500 crores in mutual funds. That's 1,800 crore of liquidity sitting on its books. So even if we net out that liquidity, the debt portion is close to 6,000 crores, which in itself is a highly leveraged position. The stock PE is at 8.84 times compared to an industry PE of 24. So the market is, not giving it any kind of a premium. Similarly, price to book value is trading at a minor discount to the overall industry at 2.2 times. The ROE and ROCE are average at best, ROCE being 15.8% and ROE being 18.8%. So overall, if I look at the financials, they're just all right, nothing out of ordinary. Yes, it does look that it is available at a cheap multiple compared to the industry, at a multiple which is much lower than the industry. But is there a reason behind it? Well, we will cover those reasons at the end of the video once we finish the comparison of PNC with its peer group. So when I look at the peer group, screen lists a few companies in its peer group, including Rail Vikas Nigam, PNC Infratech, KNR Construction, and so on and so forth. Turnover wise, 8,700 crore is nothing to sneeze at, but it's not the largest. It's one of those medium sized infra companies. The PAT percentage is 6.5% is more or less in line with the industry standards. But if we look at the industry standard, then it is more or less at a similar level. What worries me here is the debt levels. On a turnover of 8,700 crores, this company, PNR Infratech, has a debt of 8,000 crores. Look at a KNR construction, half the turnover of 4,400 crores, but the debt is only 1,260 crores. So essentially, a KNR construction revenue to debt ratio is 4 times, which means the revenue is 4 times its debt. For PNC construction, it's only 1 time. Let's look at a company called JR Infra Project. Again, the debt is 3,800 crores against a revenue of 8,500 crores, which is again a debt to sales ratio of 2 times. Rail Vikas Nigam Limited, of course, is a government company, but still debt of 6,000 crores, turnover of 20,000 crores. revenue to debt ratio of 3 times, 3.5 times. So if we look at it that way, PNC Infratech looks like it's a highly leveraged company. There are some things which PNC Infratech is doing to reduce this debt, which we will cover in the next section. In terms of credit rating, it's rated at AA, the parent company, and most of the subsidiaries are either rated at least A in all the cases. So in terms of credit rating, financial position, it's fine. In terms of revenue growth, it's a okay kind of a revenue growth story. The last 2 years, if we look at March 22, the revenue was 7,200 crores. March 23, it was 7,900, which is a 10% growth. In March 24, it was 8,600 crores, which is again a 10% growth. But the question remains: one, is 10% enough growth in this booming infrastructure market? And two, will this growth continue? The company currently has a confirmed order book of 14,000 crores and another 5,000 crores where it's an L1. So that gives us a total order book of 19,000 crores. Now, infrastructure projects typically are spread across multiple years. So 19,000 crore order book in hand today tells me that it will be able to more or less maintain its annual revenues going forward. However, Q1 performance of March 25 saw a major dip, and the management itself in its conference call is guiding for a 10% dip in turnover in FY25 numbers. So that means FY25 will be less than 8,000 crore in terms of revenues. The second question which is really bothering me is the kind of leverage it has. 8,000 crore is a lot of leverage for a company whose turnover is 8,700 crores. So the management, what it has done is it has decided to divest and sell 10 projects it has in its portfolio to another investment firm. It expects to generate a 9,000 crore total enterprise value out of it. The agreement has been signed. The equity value is 2,900 crores. That means the balance 6,100 crores will be used towards debt repayment. So if you look at 8,700 crore as the debt level, and it will repay 6,100 crore out of it, then the remaining debt of 3,000 crore becomes a manageable and sustainable debt. But that is as of today. The management is again guiding that to execute the next set of 8,000 crore worth of projects or 19,000 crore worth of projects, it has to borrow again. And even if it is a HAM project, to execute 19,000 crore of projects, you have to borrow at least 40%. So that roughly translates into 8,000 crore new borrowing, which the management is supposed to do over the next 2 years. So that will again, take the leverage up, kick it up, and if the revenue stays flat, which the management is any which way projecting that the revenue will stay flat for the next in FY25. So what happens is its debt will come down to 2,500 crore odd level. Then it has to borrow again 6,000 to 8,000 crore to execute fresh projects. Debt goes up again to 8,000 crores. Its revenue, which is today at 8,000 crore, 8,750 crores, management is saying it will drop by 10% this year. So it will be less than 8,000 crore this year. And in the next year, which is FY26, it will grow by 15%. That means 9,000 crore of revenues in FY26. But in FY26, that will mean the revenue will be 9,000 crore and the debt will be 8,000 crore. That's a very, very high leverage position for an infrastructure company to have. So in summary, PNC Infratech as an infra company has been executing projects well. Its projects are focused. 50% of the portfolio is in Uttar Pradesh, but it's present across the country. So yes, there is slight concentration risk. What if Uttar Pradesh government changes 2 years down the line? Will happen to its projects. But that's only a slight risk. So overall, the way I see this is the business has been growing at only 10% a year. The business has grown its top line by only 10% a year for the past 3 years. And going forward, the management is saying the next 3 years are going to be flat. Yes, management is doing something to reduce its leverage at the present point by selling its portfolio. But at the same time, it has to borrow again to execute the new projects. The EBITDA will remain at 12.5% management guidance for the management guidance, and the PAT levels will remain at 6.5%. So overall, if I see everything, the market is valuing the company cheaply because of exactly these three reasons. One, the management itself is predicting no growth over the next 3 years. The leverage, it will come down in the short run, but will go up again very, very shortly. Are there better opportunities available within the infra space? Are there opportunities available which are less leveraged? Are there companies in the infra space which are actually growing year on year? Are there opportunities available with better order book positions? The answer to all of this is yes. So, will I invest in PNC Infratech at this point? Maybe not. Doesn't look likely. I will, of course, look at better candidates. However, you, the viewer, are requested to do your own due diligence on the company. This in no way is a stock recommendation. Of course, I will see you in the next video.